So, what was the significance of this latest CPI print that we saw this week?
So I think a big driver in the markets was specifically the support in CPI that disinflation is in fact not dead. I know that a lot of people were really gung ho about just a few weeks ago at the last FOMC press conference. Everyone was pounding Powell for rate hikes, and obviously the CPI report came in a bit weaker than expected. I mean, we're talking 4 basis points under consensus, I think, but not really. If we round up, it's in line. Um, it was 10 basis points under the Cleveland Fed nowcast, which that can run hot sometimes, so that's not that surprising. But I think the bigger aspect here that to take note is that we saw in the contribution matrix here, you can see that core goods is slowing, energy is a positive contributor, and food is a positive contributor. But these they're not really the food and energy portions are not really accelerating drastically. They're up, but they're not up significantly. And you're seeing this big slowdown in core goods, which is good for core CPI as a whole. Now, I want to clarify, we don't really focus on core anything at Market Radar because it's not significant. What you want to pay attention to is the top line number, the most dynamic measurement possible, not core, super core, any of this nonsense, right? So if we look at headline inflation, if you take a breakdown of what's contributing to this 3.4% figure, you can see it's pretty much core services. That's holding everything up, and a good portion of core services is shelter. So shelter is still pretty hot right now, but it's coming down. And we have a couple of posts about this on X, and you can look into it if you're interested. But there is this correlation to a degree between wages and shelter, right? Like if wages are growing slower than shelter, not it's not sustainable for shelter to continuously outpace wage growth, right? And I think that wage growth, the last reading from the Atlanta Fed wage growth tracker is 4.7%. Um, Shelter's still over 5. So that alone, that slowdown there is going to be significant, I think, as shelter comes more in line with wages to really continue this disinflation trend. But we're looking a little further out on the curve there. I don't think we need to pay that much attention, right? The market was worried that the CPI print might come in hot for one specific thing. We had a monster rally in commodities in throughout April. I mean, if we just look at crude, right, going into April, finished up here, and crude went into April, I think here. We had this big move up in commodities. I guess I shouldn't say monster, but we had this strong push in commodities. There was this whole Israel conflict thing that was blowing headlines up. People were just concerned overall, like inflation. In the last print here, would start accelerate. You saw these two consecutive ticks up, right? So one in February, two in March. Now they were like, oh, great. People were concerned about a 3.5 or even higher print in
Well,
April. And sure
so
enough, we
it
didn't
seems
get that.
like the whole commodity side of CPI has come under control. Uh,
Oh,
but
100%.
for the core services side, do you think we need to see a decent push up in unemployment to see that come down?
No, I think the biggest thing that was holding up was holding us up was wages, and I think we can even pull that up here. I probably have it right here. So take a look here, right? We have shelter, and this is not updated for the last print, but the shelter is still above 5. This is down, but it's still above 5. So just imagine this coming down just a little bit, right? Shelter is still very hot, but typically shelter can't really outrun wage growth. You could see historically going back to the 90s, shelter does not outrun wage growth. So if there's this dislocation that's here, it's just because shelter's lagging. Like you can even see here, it takes a very long time to go down, a very long time to go up. It's not very rapid. It's a very smooth series, right? Very slow moving, snail moving series. So I think this dislocation gets corrected, and this gap was probably the widest in the middle of 2022 or 2023, and we've since seen this gap close. I think shelter will eventually come back under wages, and that alone will be significant, will bring down services even more, and in turn, just bring down the overall inflate or push forward the overall disinflationary trend. And I think until we really get shelter under control, this service component in CPI that we were just looking at here is going to remain um, somewhat, or this is not the right one. Sorry, guys. This one is going to remain somewhat sticky. It might come down, but you're going to need that significant slowdown, I think, in shelter to really push us forward. And until we see that, we have core goods weighing down. Likely, commodities won't be too much. Energy won't be too much of a push or a pull at the moment. And food may be a small contributor either way. But again, you could just take a look at what happened in 2022 versus what's happening now in the last print. The volatility and strength in inflation is greatly reduced, and you could just see in terms of where we were going print wise versus where we're going now. So inflation's been controlled to a degree, and this
Yeah,
is why we keep saying,
these past couple of weeks, the market's finally realizing what we've been saying throughout the entire dip, that the market's kind of getting ahead of itself and thinking inflation is a bigger deal than it really is. And now we're seeing 2 rate cuts being priced in for the year. You think that we can see 3 rate cuts? Because it kind of seems like we could possibly still recorrect and go back to that original dot plot and see those 3 rate cuts.
yeah, I think it's possible, right? At the end of the day, I think some more deterioration across employment or the unemployment rate, I should say, and along with continuing disinflation can support 3 rate cuts. Depends on the continued speed of disinflation going forward over the next 3 to 6 months from here. But I think it's possible. Um, I think we're going to get a better picture at the next FOMC meeting where we get that dot plot update, and that's where we're going to really get a better idea of what exactly the Fed is thinking about. Remember, their last statement was 3 cuts. Or the last plot was 3 cuts. So I think that's got to be the base case, right? 3 cuts is what the Fed said. Not much has really changed since the last meeting. You can claim, oh, inflation hasn't really gone anywhere, but as we showed you here, yeah, inflation is the same value as it was in 2023. I think that as long as this disinflation continues and we start to see this gradually come lower, um, and unemployment ticking higher, that there's room for 3 cuts if the Fed sees fit. But
What what
I
what
don't
are
think this.
what are job openings looking like? Because that's something the
Well,
Fed's looking at, and we need to see those job openings come down before we see unemployment start to tick up a meaningful amount.
yeah. So I think I even have one of those charts somewhere here. We can pull them right up. So what you can see here is that there's a lot of claiming or a lot of poor takes out there that the Fed rate hikes have done nothing. Nonsense. Ever since the Fed started hiking rates, they basically obliterated the job openings market, right? In terms of job openings available for every unemployed person, which is what matters, right? So if there's somebody that's unemployed, they need to be able to fill that slot or fill their employment status with a job. So there needs to be an open job to fill them, right? So if there is over one open job for every unemployed person, the labor market's somewhat loose. If someone gets unemployed, they theoretically or mathematically speaking should be able to find another job. It's when we're below one where for example, if someone were to be unemployed, there might be 2 people fighting for that one open job slot. We are not seeing that environment. We're still in an environment where there are more open jobs per unemployed person, but it's almost been cut. It's down by almost 75% since the Fed started raising interest rates. So they've done damage there, and yet people like to look at the unemployment rate and say, "Oh, it's barely moved. The Fed's done nothing." But what you're really seeing here, if you zoom out and take a bird's eye view, is the Fed has removed excess labor from the market in terms of possibilities, and eventually you run out of taking away possibilities, and jobs start getting lost at some point. And our argument has always been, look, the Federal Reserve is likely going to be too far out of sync with what's going on because they obviously are watching this ratio and the job openings, the state of job openings. So they're somewhat aware to what's going on here, but they're looking for a broader cooling in labor because their idea is if they can cool off labor, they can really cure inflation. And I think that we've seen a huge disinflation wave already happen where they don't have to end up actually breaking the labor market, but they likely will at some point. And I think we have to just play out that game step by step. And we're in stage 3 of the compound landing for now, and we're going to ride it out until that changes. But we still think that stage 4 is a likely outcome here, given how restrictive the Fed is, how glued to their restrictive or consistently supportive they are of their restrictive path. We think that they probably should have started the rate cutting cycle, even if it's a gradual one cut every 3 meetings. They should have started this already, because otherwise you end up in a situation where you have to really panic. And I think until we start to see the Fed moving in the right direction, job openings will continue to degrade. Unemployment will eventually will start lifting, and it's not going to be good because that when unemployment starts really accelerating, it means the Fed's already too late. So you kind of want to see the Fed come in beforehand. But I mean, we can go back to just the general market in terms of what happened after CPI to go back to what you were saying earlier. Market did quite well after CPI here. Nice gap up and run. And we're up here near upper vamp right now at $452 a share on QQQ. So nice move up at upper vamp. We got quite a bit of downside in short-term price action in terms of possibility. Nothing's guaranteed, right? But in terms of, we're pretty extended. I mean, just 2 weeks ago, we were at mid vamp and we've gone straight up. So we'll see how the system wants to take us from here, what it wants us to do, and we'll take advantage of the signals as they appear. But overall, great move this week on the Qs, new all-time highs on the Qs on the S&P 500, on the Dow.
And I mean, same with bonds like TLT. We're starting to see that move up towards Momo, and maybe the market's starting to sniff out something in terms of deflationary pressures. Obviously, we're nowhere near any deflationary pressures just yet, but it does seem like bonds are starting to pick something up. But however, the tens and twos are not moving up like they would be during a deflationary pivot. So I really don't know. How close do you think deflation really is? I kind of get a sense that it might be closer than we think.
That's possible. I mean, here's the tens and twos, right? We actually had the curve invert even more this week. So it's down, it hasn't steepened. And I think that people are looking for the bull steepener, right? They're looking for a situation where front end rates come down and long end rate, everything flat, everything comes down, right, in terms of overall rates. But the reason rates are coming down are because the Fed is cutting interest rates with the bull steepener. That's what the bull steepener is. But I mean, if we take a look at the global Citigroup economic surprise indices, you can see that out of all the major countries, the United States is the only one in negative territory. And what this basically means is, out of all the data that's being reported, the weighted consensus is that we are getting worse than expected data. So the wherever the analysts or estimating data come in, net we're coming in under expectations, which is not good. It's not terrible, but it's obviously showing that there's some stress, like in terms of the reported figures that are coming to the tape.
Well, could that just mean that the expectations are also just too high?
That could very well mean that. But I think that, I mean, we already saw the weaker than expected GDP number just a couple of weeks ago, right? We saw that GDP number coming, even though it was skewed because of exports. We know that the actual consumption was still strong. But in the general term here is the overall view of data right now is pretty poor in terms of where consensus is gauging it. And you're right. Consensus could be hotter than they really should be. So they can be overestimating things. But at the end of the day, if the consensus is pushing a certain trajectory, right, or target, the market's going to line up, like going to pretty much go with where people are estimating things, the economists are estimating things, right? So if this is showing negative results, that means that markets are missing estimates. Well, it's actually so far actually has been a bullish thing, right? Because what ends up happening is if the economy is weaker than what the estimates are estimating, then theoretically speaking, the economy in overall will end up being weaker than what even the Fed is expecting. Now, it's not grain for grain, tit for tat, right? However you want to play it. Generally speaking, if we can't hit the consensus estimates, we can't hit the forecasted results, then the economy is much weaker than the economists are claiming to be. Therefore, that it's likely that the Fed may have to actually bring in those cuts this year, not just one, not just two, maybe even three, right? If the economy is underperforming those estimates. So I think that this is a good sign in terms of where we are right now. Obviously, it's not bearish, right? Outright bearish. I mean, this thing's been negative for, I think, over a week now, or maybe even a week and a half. This thing's been in negative territory, yet the stock market's up, right? And we can even just see we're back to 2 rate cuts on the Fed funds forward futures chart. So we're obviously in looser forward conditions in terms of Fed policy. The data is not overheating, right? Because that's a risk here. If the data was consistently above expectations, it would be a sign that, look, maybe the Fed needs to just stay tighter for longer. And if this is weakening like this, it's a sign that, look, there might be a reason to be more dovish. And we saw this actually happen in 2023 at the end of the year when we were pricing in those 6 rate cuts. This was pretty much falling towards zero. And then right before we went into this whole prior drawdown here, this is where everything was running hot. The market was thinking, oh man, maybe there's a rate hike coming. And sure enough, this erased that hawkishness off the table.
It's funny. This is like a classic case of bad news is good news for stocks.
Yeah, because I think it comes back to the Fed being in the restrictive position, right? If the Fed wasn't overly restricted, so that's a good point that you make right there. This whole bad news is good news is only a reality if you can't claim it's bad news, or I should say you can't claim bad news is good news if the Fed wasn't restrictive enough.
Yeah, because right now it's like bad news equals the Fed needs to cut, which is good news.
Right. So for example, if bad news was bad news, right? It would imply that if the unemployment rate was going up, that would be bad news. The stock market would be selling off because the market. So if you take a step back, there is a fat cushion that the Fed has against the market where like they're somewhat overly restrictive. And I think that the market's playing seesaw, going back and forth between 6 hikes at the end of the year in 2023, 6 cuts, excuse me, at the end of 2023. Now we're back up to 2 cuts. We were just at 0 pretty much. The market's seesawing between this action because it's not really sure where the Fed's going to go. But the idea is the Fed is restrictive. And I think what ended up happening here with this whole outside this whole Israel thing, which started it, then we had some CTA unwind, some real controlled selling. But even into FOMC was this idea that like there might be a rate hike. Everyone was like on their toes, and you could just tell based on the questions Powell was getting, like the direct hawkishness from the crowd was so clear that it was very apparent that everyone's like, oh my God, why is he not hiking rates? When do we get the next rate hike? And once that was all dispelled and like taken off the table, I think the market was able to breathe again. And we pretty much since then have spent very, very little time going down and pretty much up only to all-time highs. And that's where we are right now. And I mean, you even saw some relief in Bitcoin. Bitcoin's up, but it's not up the same way as the NASDAQ is. And I think that if the NASDAQ continues in its trajectory, trends stay locked in, regime stays locked in, I think Bitcoin goes higher too. I think that obviously the key here is going to be this mid-vamp area. As long as we hold mid-vamp, bullish trends tend to lead to higher prices. That's what we say. Bearish trends tend to lead to lower prices. And if we go back to TLT, I know we just talked about TLT, but TLT is still bearish trend, right? So bearish trends tend to lead to lower prices. Until this is bullish trend, this can be faded here at Momo. It's very possible. I mean, we've seen this type of action happen before, where it gets up to Momo, it fades down. I don't know if it's going to happen the same way, and maybe we continue in this tight 94 to 90 to 89 range, chopping sideways for some time. But until this is bullish trend, patience is required if you're trying to buy long duration bonds. Other than that, I think that's where we can wrap up this podcast this week, guys. If you have any questions, feel free to reach out to us on X at the Market Radar or go to our website at market-radar.com.